with our team, with our topic, financial performance analysis. Thank you very much for your solutions. I hope you have checked, and let me open my calculations again, and we will look through left indicators. So return on assets and return on equity. I have found industry average, and you can see that our company has had in that period return on assets and return on equity that were less than industry average. But in fact, return on equity in 2015 was more than in 2014. And regarding the return on assets, the situation is about the same, because in 2014 and in 2015, the return on assets, the indicator return on asset, was about 6%. Of course, it was less than industry average, a little bit less, but it was the same. Okay, and the task for the analyst, for the financial analyst, is to analyze and to find the main causes of the changes in the indicators. So in this small, short, brief analysis, we have tried to find the main causes, the main explanation of these changes. For example, regarding the return on assets, as you see, we wrote that perhaps such a small decrease in return on assets in 2014 and in 2015 is due to a decrease in net profit of the organization, with the growth of value of fixed assets, current and non-current assets, with a decrease in asset turnover. So your task in financial performance analysis will be the following: to calculate appropriate ratios and to analyze it, and to conclude, to make a conclusion about the financial status of the company. Okay, and some words about next ratios. So let me come back to our presentation again. And our next ratios, it is the group, the next group connected with the liquidity and the working capital analysis. So what do you remember about the term liquidity and liquidity assets? What is the main idea of the liquidity, and what assets can be called liquid assets? What do you remember from the previous course, or maybe you have the practice in financial analysis, maybe during your internship or something like that. So the group of these ratios is called liquidity and working capital ratios for working capital analysis. So what do you remember about the liquidity as a term or special term and liquid assets? So on our previous lectures, or maybe earlier, we have mentioned the term liquidity and liquid assets. So let's recall liquidity. So liquidity, it's ability of a company to meet short-term obligations using assets that are most readily converted into cash. And liquid assets, they are listed in financial statements as current assets. Current assets or short-term assets, these assets are used to satisfy short-term obligations. These assets are used for day-to-day operations. And the example of the current assets, and could you give me some examples of the current assets? So using the microphone, use the chat box. I'd like to stop for a while in order to look at the chat box. So current assets, we use it for day-to-day operations. We use it during one operation cycle, or about 1 year. Usually it's our cash, our receivables, account receivables, securities, liquid securities. So it is our current assets. And the difference between the current assets and current liabilities is referred to net working capital. Inventories, okay, inventories, of course, inventories. Thank you. And stocks, inventories, stocks. Okay, produced goods, cash. Okay, thank you very much. Okay, thank you. And let's come back to our presentation. So let's talk about the ratios, liquidity ratio. So we have several liquidity ratios, but most the most popular ratios or most well-known ratios are current ratio, quick ratio, net working capital, and net working capital to sales ratio. So on my slide, on this slide, you can see the formulas. So current ratio, it is relation current assets to current liabilities. Quick ratio, it's current assets minus inventory to current liabilities. And net working capital to sales ratio, it's logic that at first we have to find the difference between the current assets and current liabilities. It is net working capital, and then find the relation current assets, current liabilities, net working capital to sales. The interpretation. In order to get the interpretation, again, we have to know that there is a normative values, and also we have to compare these ratios calculated in the current period with the ratios calculated for the previous periods. As for the normative values, in your folder, in this lecture folder, you can find a ratio analysis file in Microsoft PowerPoint. And there are some normative values for some ratios. These normative values came from foreign practice, and these normative values calculated based on the foreign companies' data. So if you'd like to apply these ratios in Russian environment, you have to take into account that there is an international practice. So these ratios came from international practice, from the international statistics. Maybe it's worth doing the following: try to find the industrial average, try to compare with previous ratios, and then of course you may apply and you may use the normative values, but take into account that it might be different because of the difference in environment, in Russian environment and foreign environment. So let's look at the file I'm talking about. So now let me open this file. Ratio analysis, the name of this file. Okay, so this is Russian English version. So for your convenience, I wrote the Russian name and English name. So in order you both foreign students and Russian students could use this file. So you can see the English version and the Russian version of this of the name of these ratios, and you may see the normative value for some ratios, for current ratio, for current liquidity ratio, for quick ratio, and please cash assets ratio, quick ratio, current ratio. So for these three most popular liquidity ratios, you can see the normative value, but please pay attention that it's based on the foreign enterprises data. And you may see the formulas, and you may see the English version and formulas in English version. And I'd like to explain you why I've highlighted the third component of quick ratio formula. In order to calculate the quick ratio, we have to use the most liquid assets: cash, account receivables, marketable securities. As for the marketable securities, it's important that in this case you have to use only most liquid marketable securities. So it is your task as for the financial analyst to choose from all of the marketable securities you have in the financial reports only those who only those marketable securities that are most liquid. So you have to choose yourself most liquid marketable securities. And in this presentation, you can find also the financial sustainability indicators and its interpretation, and its Russian version and English version, formulas and normative values. So you can use it in your practice. Okay, so let's come back to the presentation about the financial performance analysis, and let's analyze, let's continue our discussion about the liquidity ratio. So the most popular, the 3-1 generally accepted in the creditworthiness analysis, the bankruptcy risk analysis, it is liquidity ratios, current liquidity ratio, quick liquidity ratio, and this third one, net working capital to sales ratio. But also we can calculate the following indicators of operating cycle in order to understand the duration between the time cash is invested in goods and services to the time that investment produces cash. So as you remember from our previous lecture, we have discussed what the operation cycle is. So the classic operation cycle can be described in the following way. This operating cycle may have 4 phases. For example, purchase raw material, produce goods, so investing in inventory. Phase number 2, sell goods, generating sales, which may or may not be for cash. The third stage, extend credit, creating accounts receivables. And fourth stage, collect accounts receivables, generating cash. So it is operating cycle from purchasing raw material to generating cash. And it's very important to understand the duration of operating cycle. And it's important to compare our operating cycle and to analyze operating cycle. And if something changed in, if there are some changes in operating cycle, we have to analyze the main causes of these changes. What are the main causes? If we have these changes due to the changes in duration of number of days of inventory, or maybe it's due to the changes in the duration of our account receivables. So we have to find these main causes, negative causes, and we have to make appropriate managerial decisions. For example, you may see on the slide, you may see the main formulas. So the operating cycle is the length of time it takes to convert an investment of cash and inventory back into cash. And the net operating cycle is the length of time it takes to convert an investment of cash and inventory and back into cash, considering that some purchases are made on credit. So that's why the net operating cycle, it is the sum of the number of days of inventory, number of days of receivables, we mean account receivables, minus number of days of purchases. And in order to understand the duration of our operating cycle, we can find each component of the operating cycle, number of days of inventory, for example. The first component, first element of our operating cycle, we can calculate it, inventory to average days cost of goods sold. So average days cost of goods sold can be calculated in the following way: cost of goods sold divided by the number of days in the year. So 365. And then the second component or second element of our operation cycle is account receivable. In order to calculate the duration of accounts receivables or number of days accounts receivables, we have to find the account receivable to average days sales on credit. And this element, average days sales on credit, can be calculated as sales on credit divided by 365. So the logic is the same. We have to find the duration of this phase when our money can be converted into cash. Then we can find the number of days payables. So the logic is the same. Accounts payable to average days purchases, and the average days purchases can be calculated as the purchases divided by 365 or 360. Sometimes it's appropriate. Purchases. What is the value? What does it mean, purchases? In this case, we can use cost of goods sold, for example, or we can find the more correct value from our details. If we can look at our accounting base, for example, in Russian Federation, we use the program software 1S in Russian. So if we use this system base, accounting base, for accounting purposes, we can find this more correct figure in order to use it instead of cost of goods sold. Then let me tell you somewhat about the activity ratios, and we will practice a little bit. We try to calculate some of these ratios in order to practice. We will use again the financial reports of our company that we used before. Activity ratios. It's connected with the previous months, with the ratios that can characterize of our operating cycle. We use activity ratios in order to characterize our efficiency and to understand how well assets are used. Sometimes we call it turnover ratios. And we can analyze it, and we can get the following interpretation. The greater the turnover ratio, the more effectively the company is at producing a benefit from its investment in assets. We can calculate the following activity ratios: inventory turnover, accounts receivable turnover, total assets turnover, fixed asset turnover. And the main logic is the following. For example, inventory turnover is the ratio of cost of goods sold to inventory. And the logic is to indicate how many times inventory is created and sold during the period or operation cycle. And we will use the following formula: cost of goods sold to inventory. Again, the same logic we will use in calculating the accounts receivable turnover. In order to understand how many times in period credit sales have been created and collected on, we have to use the following formula: sales on credit to accounts receivable. And again, we have to find the several values for several periods in order to compare, because there is no any normative value. We have to compare with industrial average, but in this case, in case of accounts receivable turnover, inventory turnover, we usually use the comparison with the previous indicators, previous periods indicators for previous periods. And total asset turnover. We have to find the relation sales to total assets, and this ratio indicates the extent that investment in total assets result in sales. And fixed asset turnover, it is relation sales to fixed assets. So we analyze the ability of the company's management to put the fixed assets to work to generate sales. And now let's try to understand what's going on with these activity ratios, liquidity ratios, turnover ratios in our company Time Warner. And some words about the turnover ratios and a number of days. There is a connection between the turnover ratios and number of days. For example, number of days inventory to average days cost of goods sold in days, and inventory turnover, it is indicates a ratio cost of goods sold to inventory. So what is the connection between these indicators? There is a connection, a relation between these measures of operating cycle and activity ratios. So the more number of days in inventory, the worse situation with our liquidity and with our efficiency of using the assets. But the situation is another when we are talking about the inventory turnover. If we are talking about the turnover, the more we have the inventory turnover, the better situation with our activity in terms of efficiency, and the better situation with our liquidity, because it means that we are getting cash in a more rapidly. So please take into account on this relation and connection between the measures of the operating cycle and activity ratios. So this is the relation again in formulas, inventory turnover. So we have we can calculate it in numbers, in number of days, and as an indicator, as a ratio, just ratio. And the same situation with other ratios, account receivables and account receivables ratio, inventory ratio. So we will practice now based on the Time Warner financial statement. So I'd like to stop a demonstration for a while, and let's look at the next task connected with the Time Warner. So the next task is connected with the liquidity ratios and activity ratios. So try to calculate any liquidity ratio or any efficiency ratio. I mean turnover ratio, like account receivable ratio, total assets turnover ratio. So you may choose one of these ratios, and please calculate yourself individually. So you may choose any liquidity ratios, current, quick ratio, or you may choose and calculate efficiency ratio or turnover ratio. I mean, account receivable ratio, inventory turnover ratio, total assets turnover ratio. And I give you about 7 minutes in order you could calculate any of these ratios, one or two of them, and please try to get the interpretation. So try to compare the calculated ratio with the previous period. So you may compare 2 periods only, because we have the data for 2 periods, 2014, 2015. Please compare, and please try to analyze and get the interpretation. Try to understand what about the changes, and why, what are the main causes of these changes. Looking at this balance sheet, I'd like to tell you that for you it's better to calculate liquidity ratios now, and you can calculate it and compare it without any problem. As for turnover ratios, as you remember, as you understand, in order to calculate the turnover ratio, we have to find the average. We have to use the average account receivables or inventory. In this case, we have only 2 periods, so we have not enough data in order to find the turnover ratios properly, in proper way. So it's up to you, of course. Try to find any of these ratios, and I give you 10 minutes, and then we will discuss together. I will show you again my calculations. I will show you my comparison with industrial level, and I'll explain you the correct approach. So please work individually now. Work individually, and you will find this description of this task in the folder with the date of our lecture, 18th of March. And also you will find the file, XLS file with these financial reports. Maybe it will be convenient for you to use financial reports in XLS, in Excel. And then in 10 minutes, we will work together. If you have any questions, please let me know by using chat or microphone, and I will help you. Okay, I can see the answer from Karina. Thank you. But I can't. Yes, I can enlarge. Current ratio, quick ratio, and not net working capital. Okay, we will wait a little bit and then we will discuss together. Maria, thank you. Inventory in days, in and ratio. Okay. Thank you. And let me open my calculations and let's check together. So you are right. You have calculated in proper way. And let me. I'd like to send you my calculations in order you could use it separately, and then I'd like to briefly comment something. So please find in chat box my calculations. There you can find the comparison with industries, with industrial average. And now I'd like to open this file. So in my file you can find some ratios. Oh, sorry, there are no industries in industrial comparison, but I have compared with the previous period. And I'd like to tell you that current ratio, quick ratio, we can calculate without any problems, but for calculation, the activity ratios, inventory, account receivables, total assets turnover, according to the methodology, we have to use as inventory, account receivables, and total assets the average. So we have to find the average of inventory. We have to find the average as the simple average from the ending of inventory for 2014 and ending of inventory, so closing stock of inventory for 2014 and closing stock of inventory for 2015. And the same logic we have to use for accounts receivables and for total assets. So it is our methodology says that we have to find the inventory and accounts receivables and total assets based on the average. But in this case, we can't find the average because we have no enough data for calculating this in this way. So we have to use only these data for 2014 and for 2015. I have checked your answers and you were right, you were correct, you have correct answers. And I have some brief analysis. So in your home task, when you make the creditworthiness analysis or bankruptcy risk analysis, you have to make the brief analysis for each ratio. So you have to compare with industrial level if it's possible with the previous periods, and please try to understand the main causes of the changes. Try to find these main causes, try to make the assumptions. Okay. So any questions about this part, ratio analysis? And then if we have no questions, we will move to the next part, the creditworthiness analysis and bankruptcy risk analysis. I'd like to tell you some general information about this kind of analysis. I'd like to tell you what are the main purposes of the application of creditworthiness analysis and bankruptcy risk analysis. So if you have no questions about our lecture part connected with the ratio analysis, let's move to the creditworthiness and bankruptcy risk analysis. So let's come back to our presentation. So the ratio analysis is the core part of the creditworthiness and bankruptcy risk analysis. And your home task of the fourth model will be connected with the creditworthiness or bankruptcy risk analysis. So the core part of the creditworthiness and bankruptcy risk analysis of your home task will be connected with the ratio analysis. So the main purpose of our lecture is very clear for you, I hope. Let's talk about some terms. So let's recall what the creditworthiness is. So the creditworthiness is ability to meet agreed deadlines related to repaying the credit and the interest accrued without affecting the vitality of the borrower. So any bank has its own methodology dedicated to the creditworthiness analysis. And this methodology implies that we have to make the financial analysis and qualitative or non-financial analysis. As for the qualitative analysis implies the legal analysis of legal and reputation aspects, business reputation of potential borrower, economic analysis of economic environment of the borrower, and the financial analysis implies that we have to calculate some ratios. As a rule, it's liquidity ratios, indicators of financial sustainability, turnover, profitability ratios. So all the ratios we have mentioned above. The stages of the credit analysis are as follows: collecting and analyzing information about the company, then collecting and analyzing information about the credit deal, assessing the credit risk, checking the reliability of the information provided the company, preparing credit risk analysis report dedicated to the credit risk analysis, taking a decision, If we are talking about the bank, credit committee will make the decision and setting the credit terms in a special agreement. And if we are talking about the creditworthiness analysis, it's always this question is always connected with the credit policy of concrete bank. Credit policy and the methodology of creditworthiness of certain and concrete bank. And that's why a part of your home task will be connected with the following. You have to choose the appropriate creditworthiness methodology and based on this methodology, you have to make the creditworthiness analysis. If you choose the second task, the second version of your task, and you would like to make the bankruptcy risk analysis, on this slide you can find some sources of the information. It is the link to the recommendations about the financial performance analysis procedure for arbitration managers. It's from our Russian legal system, our legislation. Then you can see on this slide the link to the bankruptcy law of Russian Federation. So it's our bankruptcy insolvency law. And a little bit later, I'll put in tutorial lecture 4. There are some examples of financial performance analysis from my credit, from my bank experience. So it is the samples of financial performance analysis, credit analysis from my bank experience. So you can see it a little bit later. You will see it a little bit later. And if we are talking about the assessment of the bankruptcy risk, and for this task, in this to make the assessment of bankruptcy risk, we have to use some methods. Of course, this method that is based on the net working capital. Of course, we can use the financial ratios analysis, and of course, we can use different kind of models, score methods based on the models. Developed by Altman, Olson, Zmeyevsky. These are the most popular models. And of course, nowadays we can use a lot of modern models, but mostly modern models are based on the well-known models, are based on the Altman models, Olson and Zmeyevsky. Please take into account when you use these models, Altman, Olson, Zmeyevsky, and adopted versions of different models, that predictive power of these bankruptcy prediction models differs between countries, between industries, time periods, firms' age, firm size. And when we are talking about the bankruptcy risk models, in literature, there is a lot of discussive topics. And these topics, in these topics, experts have mentioned the following problem. These models cannot be generalized. because these are developed using a specific sample from a specific sector, specific time period, specific country. And that's why it is a very discussive topic how to adopt these models. But it is the negative side. But the positive side is connected with the fact that there are a lot of space for future research. So you can use this topic, bankruptcy risk models and insolvency risk models, and you may use it for your research, for thesis paper, in bachelor program, in master program, and then in PhD. And you may develop and develop and develop, because there are a lot of spaces, a lot of space for future research. Then some models. So I'd like to tell you somewhat about the models Altman, Olson, Zmeyevsky, and some interesting results of the recent studies. So you can see on my slide these interesting results. I've highlighted the most important things. So Altman, Olson, Zmeyevsky, this model are well known, most cited ones. And the most important thing that the predictive power of these bankruptcy models differs. And nowadays, experts try to adopt these models and try to apply these models in different sectors, and they got interesting results. So in my presentation, I showed you some interesting results of recent studies. For example, in 2019, Ashraf found that both models by Altman, and Altman had developed a lot of models, but his model from 1968 and the model of Zmeyevsky are still valuable for predicting the financial distress of emerging markets. So it's interesting that these models developed by Altman and Zmeyevsky work well, function well for emerging markets. So these models developed by Altman and Zmeyevsky can be used by specialists who are thinking about investing in emerging markets. Then another interesting results of the recent studies, Elviani and his colleagues in 2020 studied the accuracy of the Altman, Olson, Springate, and Zmeyevsky models in bankruptcy, predicting trade sector companies in Indonesia based on binary logistics regression. And the results are interesting. So the most accurate models in predicted bankruptcy of trade sector in Indonesia are the Springate and Altman models. So for you, it's another space for the research. Try to use different models and compare the predicting power in different sectors, or compare the predicting power of different models in one sector, or using these models in concrete sector in concrete country, and to compare their predicting power. Okay, so in order to predict the bankruptcy risk, we can use different type of methodology: statistical, stochastic, artificial intelligence methodology, data envelopment analysis. And on my slides, you can see the authors of different models. And in your research, in your home task, you may use any of them. And then I'd like to tell you some words about the models and the interpretation. So, of course, I'd like to tell you briefly about these models, and in details, so detailed description you may find in the special literature, and in this special literature you may read in details the interpretation of these models. For example, Altman model, it's a well-known model, and Altman developed different types of models for listed companies, for unlisted companies. So the classic a type of his model has the following form. This model consists of 5 elements, and on this slide you may read about the interpretation. So the main logic of this model, that the lower the Z-score, the higher the odds that the company is heading for the bankruptcy. For example, a score between 1.8 and 3 means that the company is in gray zone or gray area with a moderate chance of filing for bankruptcy. If company shows Z-score close to 1.8, the investors may consider selling the company's stock to avoid losing their investments, since the score implies a high probability of going bankrupt. So this is the interpretation. The next model, Conan called a model. It's a model for small and medium business for predicting the bankruptcy in this type of companies. So you may see the description of the elements of the model, and below you may see the interpretation of that score. So less than 0.04, probability of bankruptcy risk of more than 65%, between 0.04 and 0.16, and probability of bankruptcy between 30-65%. So then Springate model is also well-known model, and you may see the elements, 4 elements of this model, and the interpretation of Springate model. Z-score, the company is bankrupt, and company has a good performance, depending on the meaning of the Z-score. And then Tafler model is again is another well-known model. 4 elements in this model, and the interpretation of Z-score of Tafler model, more than 0.3, the company has a good chance for performance. A gray zone or undefined area between 0.2, 0.3, and less than 0.2 show that the company is almost bankrupt. And Zmeyevsky model, Zmeyevsky, 3 elements, and you may see the elements of this model and the interpretation. So the firms with probabilities greater than or equal to 0.5 were classified as bankrupt or having complete data. Firms with probabilities less than 0.5 were classified as non-bankrupt or having incomplete data. So your home task is connected with these materials. So you have to read again this presentation before you start making the home task. You have to understand would you like to make the creditworthiness analysis or bankruptcy risk analysis. You have to choose appropriate methodology. You have to find the appropriate methodology of creditworthiness. So try to find the creditworthiness of any bank. If you choose the bankruptcy risk analysis, okay, you have to choose any appropriate for you model and try to apply this model based on your company and try to get the interpretation. But please remember that the final aim of your analysis is to conclude about the financial sustainability of your company. So any analysis, creditworthiness or bankruptcy risk analysis, should include the ratio analysis in order you can conclude about the financial sustainability of your company. So ratio analysis you should use in order to conclude, you should use in order to make the conclusion about the financial sustainability. So again, I try to explain you the logic of our home task. I'd like to open our presentation, the course presentation with our home task, and repeat some words about the home task for the fourth model. Maybe some of you will want to start doing making this home task. So the main idea is to make the creditworthiness analysis, bankruptcy risk analysis, and the results of your work in class presentation, written analytical report, and the structure of your report. So please pay attention that the ratio analysis, it is the obligatory part of your report. But then, depending on your choice, bankruptcy risk analysis, it is analysis based on the chosen model, and conclusion about the creditworthiness based on the approach methodology chosen. And obligatory part is a general conclusion about the company's sustainability. So anytime you may ask me about this task, and all these materials, I've put all these materials in your folder, studying folder in the lecture. You will find all these materials there. And if you have any questions about this our lecture dedicated to the financial performance evaluation, please, you may ask any questions and I'm ready to answer. Okay, if you have no questions, thank you very much for being here, for participation. In the nearest days, we will send you the current statement with your marks for the tests for the lecture feedback. So if you have any questions, so you may ask anytime Olga Fyodorovna and me about the tests. And in the beginning of our next model, we will come back to the test and we will comment something. Maybe we will ask some questions if you have ones, and we will send you, of course, the solution. And if you have any questions based on the solution, so you may ask us via email, via chat box, or maybe on tutorials if it's convenient for you. So thank you very much for being here again. I'm here, so if you have any questions, please ask me, and have a good day. See you next time.
Thank you.
Thank you.
Thank you. Goodbye.
Bye. Thank